Hi, and welcome to the webinar, Employee Retention Tax Credit. I am Ms. Meralda from the Maricopa Small Business Development Center. I'm going to be the facilitator for this webinar. I will be monitoring the chat throughout the webinar. So if you have any questions, make sure that you put them in the Q&A instead of the chat so they don't get lost. We'll be having Tom He will be introducing himself, and CariAnn from Peach Fleischman. So Tom, you ready?
I am. Go ahead and share screen. All right, welcome everybody. Today we're going to be talking about the Employee Retention Tax Credit, and is it right for you? I know if you're anything like me, I have found this particular program very intriguing and very confusing at the same time. But I know there's opportunity out there, so that's why we reached out to an exceptional expert. What I can tell you is that it's a program launched with the CARES Act in March of 20 and was modified and extended as part of the Taxpayer Certainty and Disaster Relief Act, which I didn't even know was a thing, in December of 20. The Employee Retention Credit is a fully refundable payroll tax credit for employers that equals 50% or 70%, depending, of qualified wages up to a $10,000 cap that employers pay their employees. Today, we'll cover some tips and provide insights to help you better understand it. Takeaways include reviewing of the eligibility requirements, how to calculate, understanding the application process, explain the interaction with other disaster relief, and provide an update on IRS timing if there's any available yet. I know that our speaker shared with me that it's a heavy PowerPoint with lots of information, but she also pointed out every blurb matters. Not that we'll cover every blurb in detail, but it all matters. It's a complicated program. So my name is Tom Fulcher. I'm a business analyst with the SBDC. I've been with the SBDC 11 years now. I'm a member of our capital team. In particular, I've done some lending. Most of my expertise is in the area of angel and venture capital. I'm also a member of our export team, and I am the Venture Madness Mentor Chair for anyone who's involved in that program. Maricopa SBDC is a part of the America's SBDC Arizona network. We have 17 counselors in Maricopa County and 10 centers around Arizona. And as I said, we're part of the national network. We provide one-on-one counseling at no fee. And if you are a business owner, we'd love to see you and see where we can help you. We also provide a variety of training. We'll be talking about that at the end of our program today, and a whole variety of resources, whether it's Growth Wheel, which is kind of a planning tool for you and your counselor to work together, market research tools, and many, many others. Some of the areas that we provide disaster assistance or technical assistance include disaster loans. Carrie and I got to know each other through this wonderful disaster loan relief program with PPP and EIDL, and insert your favorite set of initials here. There's probably a program called that. We have lender readiness preparation for more traditional lending or SBA lending, financial reviews and resiliency assessments, marketing assessments and planning, buying and selling a business and exit strategies. We have a manufacturing expert, technology and commercialization, export and international trade, and through our friends at the Procurement Technical Assistance Center can help you with government contracting. So some of the resources we have, I mentioned the Growth Wheel. We also have LivePlan, which is a tool that you can work with your counselor and develop your actual business plan, including your forecast, right in a collaborative shared resource. We have ProfitSense, which I'm sure our speakers are aware of. So ProfitSense is put out by SageWorks. And we get industry data. If you're curious what another business that looks like you is, maybe in the Western US at this size, what do their financial data look like? What percent is this? What percent is that? And we can actually directly input your data into that and get a comparative analysis to the averages in the industry. SBDC Net serves the entire United States. They're out in San Antonio, Texas. And they help us with all kinds of research questions. We don't do primary research, but if there's secondary data out there we can find, they're the ones who are going to help us find it. And of course, we also are subscribers to IBIS World, another research tool where you and your counselor can look online for research reports that are specific to your industry and pull down some very, very useful data. So before we get started, Esmeralda, we're going to take a little poll and ask you to tell us a little bit about your business. And what we want to know is, have you applied for the ERTC already, the Employee Retention Tax Credit? And Esmeralda, are you able to launch that poll? All right, I'm not hearing you, Esmeralda. I don't see the poll. Is it up? There it is. So we want to know if you've applied for the tax credit. Yes is a simple answer if you have, or you don't plan to apply. But then probably most of you are one of these last two. I'm not sure if I should or not, or I want to, but I don't understand how. So everyone just, choose what applies to you, and we'll kind of get a response from everybody and see where we stand.
Here are the results.
There we go. So a couple of people have applied. And I'm sure we have a number of people applied and are saying, how do I, I'm not hearing anything. Someone is not sure. And we have some people who said, I want to, but I don't understand how, which is, CariAnn, what I thought the majority of people would say. So yeah, so you're at the right place. So, today is kind of a learn, ask, apply, hopefully. We'll start with a few facts, reviewing eligibility terms and key rules, explain the process. And we also got a number of pre-submitted questions that I believe CariAnn has already covered in her presentation, but we did share those with her as well. And I keep saying we, but really it's not me. I'm here just to host you. Our speaker is the wonderful CariAnn J. Todd. CariAnn is Senior Manager in Beach Fleischman's Accounting and Assurance Practice and Director of the Employee Benefit Plan Audit Group. She provides client service in the areas of audit, accounting, and consulting for a variety of privately held businesses. For the past 16 months, CariAnn has been a leader on the Beach Fleischman Task Force for the Paycheck Protection Program, more recently become an expert on the Employee Retention Tax Credit. Many of you, if you've attended some of the Arizona Commerce Authority Small Business Bootcamp events, aside from seeing some SBDC people present, you've probably had the pleasure to see CariAnn. And I am going to stop sharing and turn it over to CariAnn. All I can add to the predetermined bio is she's amazing and just a wealth of knowledge. And we're very, very fortunate to have her join us today. So CariAnn, I'll stop sharing and let you take over.
All right, thanks, Tom. That's quite an introduction. I mean, you kind of set me up. I got to be awesome, or people are going to be really disappointed. I want to thank Tom and Esmeralda for having me today. The Employee Retention Credit is, if I told you it was easy, I'd be lying. So I'm just not going to lie. It's really complicated. And I say that in meaning there's just a lot of steps and you have to work your way through the steps. And that's what we're going to try to do today. I've got a PowerPoint presentation we're going to go through, and then I've got several things that are resources, like we're going to look at some 941s and see what those actually look like. So I might be like in and out of my screen share today on different screens. So we'll try to work through that. I can't figure out how to do it that seamlessly in Zoom. But anyway, so let's work through it. There's a lot of slides in this presentation. There's 54. We're going to try to go through them high level to some extent, but also detailed. And then we're also going to do questions as we go. And I need to figure out, Tom, if you'll just, when appropriate, just interrupt me and read out questions. I think that would be best because I can't necessarily always see the questions as they come up.
No worries. So as Esmeralda said, everybody, please enter your questions in the Q&A tab. If for whatever reason you're shy and don't want to put them there, you can also chat them to one of us. But try to enter them in the Q&A tab, and that way I can, CariAnn, notify you at an appropriate break point that there's a question.
Okay, sounds good. All right, so this program hasn't really changed a lot in some ways since it came out with the CARES Act in March of 2020. What has changed is that when the CARES Act first came out, there were two really big provisions that they put out there for small businesses to be able to help. There was the Paycheck Protection Program and the Employee Retention Credit. And when the CARES Act came out, you could do one or the other. You could either get a PPP loan or you could take advantage of the Employee Retention Credit. both of them were very lucrative. And I think that's why initially they made them an either or. So most businesses went for the Paycheck Protection Program because it was easier, it was faster, they could get the money faster. And so most businesses did that. Nobody really did the Employee Retention Credit because they got the PPP loan. In December, Congress changed the rule and said, okay, now it's not an either or, it's an and. And so now businesses are scrambling, trying to figure out, okay, do I qualify for the ERC? Because everyone kind of ignored it once they got their PPP loan. Do I qualify? Am I eligible? Should I go back and amend my 2020 returns to try to get some money? So that's kind of how we got to where we're at. And then it also extended the program initially through June 30th. And then later on, they enacted more legislation in March that extended the ERC through the end of 2021. So we've got almost 2 years we can go back to that we're eligible or periods for the ERC. So we're going to kind of talk through those independently. The rules are kind of the same, but they're kind of different. In addition, in March, congressional action kind of did some changes with the math. That first bullet point doesn't really matter to you. It's just math on the 941. It added this new category of eligible businesses, a recovery startup business. I'll just pop to that slide. A recovery startup business is a business that started after February 15th. You have to have average annual gross receipts of $1 million or less. You can't otherwise qualify on the other tests. And you can only claim ERC for Q3 and Q4 of 2021. So that's something new that was added for businesses that did start in 2020, because initially anyone who started after the CARES Act was basically out of luck. The CARES Act was really for businesses that were in business when the pandemic hit. Like I said, extended the ERC through the end of this year and then extended the statute of limitations. Not really that big a deal, but just something you should be aware of. Okay, so we talked about that. So what is the ERC? So the ERC is computed using eligible wages and allocable healthcare costs. And it's a payroll tax credit. So let's just get that out there to begin with. It's a payroll tax credit. So it's going to be a credit against, but it's refundable, your payroll taxes. So this is not on your personal return. This is not on your business income tax return. This doesn't affect those things directly. This is a credit you're going to claim on your payroll tax reports, the Form 941 that you file quarterly. Okay, so this is a payroll tax credit. These are the two things that are eligible: wages and allocable healthcare costs. So those would be healthcare costs that you as the employer pay for your employees. You can't take the credit on the portion that your employees pay. It's only the portion of the premiums that you pay as the employer. Like I said, the credit's available from March 12th of 2020 to the end of this year. The computations for 2020 and 2021 are different. And so I've tried within the presentation to make it super clear when we're talking about each year. So I've got this beautiful blue screen. So for the next, until you see another blue screen, we're going to talk about 2020. Okay. So right now I just want to focus on 2020 because I think there's a lot of businesses that do qualify and are eligible to go back and claim the ERC for 2020 by filing an amended 941. And I have examples of that. I'll show you how that works. We'll go through all that. The biggest candidates for this are restaurants because they were shut down by government order. So if you're in restaurant, hospitality, anything that was directly affected by a government order that said you have to shut down, you're eligible. And any business that had a significant decline in gross receipts. And we'll talk about that specifically. But there are a lot of businesses that can qualify for 2020. Okay, so like I said, there's two ways for 2020. You can have a full or partial suspension of operations, or you can have a significant decline in gross receipts. So let's talk about this first one. And it's or, not both, okay? So a partial shutdown means that a government order, think about all the government orders that Governor Ducey issued for the state of Arizona. Those are the government orders we're talking about. And if you go to their website, actually, if you just Google Ducey executive orders, it'll take you right to the website. They have a chronological list of every single executive order that you can look at. And if you need to get a chronological timeline of what happened to your business, but basically you had to have a partial shutdown. What is a partial shutdown? Okay, here's an example. A restaurant that's a dine-in operation, okay, is limited by an executive order from the Arizona governor to takeout only. Everyone remembers this. Restaurants are a good example because everyone, I think, regardless of what business you're in, as a consumer, these examples make sense to you. So if you remember, initially restaurants were told takeout only or drive-through only. If they take out and drive-through, if they had a drive-through. And then, excuse me, in May, a subsequent order said, okay, you can keep doing takeout and drive-through, but now you can also do dine-in, but you have to limit your capacity to 50%. And then there were other rules about, segregation of tables, 6-foot distancing, all of those things. In this case, a restaurant is deemed to have essential and non-essential operations. And that's a key term if you go back and read the executive orders, because they talk about essential operations and non-essential operations. And in terms of this restaurant, they're deemed to have essential. So their takeout, and if they had a drive-through is deemed essential because it was not restricted. And then they had non-essential operations, the dine-in portion of their business. So in this case, the non-essential operations that are restricted by government order represented more than 10% of their revenues in 2019. And that's why I said it's a primarily dine-in operations, and that's critical because that dine-in portion has to be more than 10% of revenues, okay? So under the rules, this restaurant experienced an eligible partial shutdown from March 20th, when the first, hey, you can only do takeout, all the way till 12/31, because as you recall, the 50% dining restriction was not lifted until March 6th of 2021. So, they were restricted the whole entire time. Another example, just to give you a second example for context, is dentists. So when all the executive orders came out, like primary care and normal physicians were deemed essential and for the most part allowed to keep operating. But dentists were said, hey, you can only do emergency services. You can't do cleanings, preventive care, any of that. You can only do emergency services, for the time being. So on March 21st, they shut down routine care, and then they opened it back up on April 30th. So for regular dentists, they had a partial shutdown between March 21st and April 30th, because again, they were deemed by executive order to have essential and non-essential operations. The essential being the emergency services and the non-essential being the routine. Because the routine operations represented more than their revenues, more than 10% of their revenues in 2019, they meet all the requirements. So those are two examples of a partial shutdown. They're not the only examples. There's like a 20-page IRS notice that you can go through that will go through all the different ways. And there's a lot of examples in there about partial shutdowns. But I felt like these are two that everyone could kind of understand as a consumer what we mean when we're talking about a full or partial shutdown in terms of the ERC. Yeah.
Yeah, we have two questions. We actually have more, but two that relate to this. First one is, we have employees who could not leave the reservation for work due to shutdown. It impacted this business to be able to offer services. Does that qualify?
Okay, so your employees were unable to come to work, but your business was still able to operate? Is that what you said?
It said, yeah, the employees were unable to cover the work, and because of that, they couldn't offer services.
Right. So I don't think that meets the requirement because, and I know that's not an answer anyone wants, but the rule says that the government order has to restrict the business itself. And it actually gives an example that says, if you're an auto shop and you don't have any customers because nobody's driving their car, this employee retention credit doesn't apply to you because government order deemed auto services as essential. So indirectly, the fact that you didn't have any customers is not a qualifying event. So I mean, I would tend to say the same analogy would apply for employees, unfortunately.
Yeah, and that's relative to what you're talking about, the shutdown aspect versus the
Right.
significant decline. The other question that was, I think, probably a simple one: can businesses receive credit for both 20 and 21?
Yes.
Okay. And just so everyone knows, I did put the link to Governor Ducey's executive orders in the chat. So CariAnn, back to you.
Thank you. Okay, so that's partial shutdown. And again, that's one way to qualify. The other way to qualify is by looking at gross receipts. And like I said, it's an or, not an and. So if your gross receipts for 2020 are less than 50% of 2019, then you have qualifying. And I'll show you the math on how that works. It's kind of critical you're able to do your accounting on a quarterly basis. Because all the provisions in this are based on a quarter, and then you file for the credit on your quarterly 941. So you really need to have accounting for all your business records on the quarterly basis. And these are calendar quarters. Even if you have a fiscal year, all of this is based on calendar quarters, just like the 941. It's not a fiscal quarter, excuse me. So here's an example. So you would schedule out your gross receipts, your revenues by quarter for 2019, and then you would do the same thing for 2020, and then you look at the relationships. So you can see, and the relationship means 2020 as a percentage of 2019. So like you can see in quarter two, 25,000 is 42% of 60,000. So because that 42 is below 50, you become eligible for quarter two. And the rule says you stay eligible until the quarter after the quarter in which your gross receipts exceeds 80%. Like I said, it's not that simple, but if you kind of just follow it through step by step. So in this example, this first one here, my gross receipts never got more than 80% of 2019 gross receipts. So I'm eligible for Q2, Q3, and Q4. In my second example here, you can see that in Q3, my gross receipts were 83% of 2019. So therefore, I'm eligible for Q2 and Q3, but not Q4. And that's because I crossed the 80% threshold in Q3. Okay. All right. So if you figure it out, okay, either I pass the partial shutdown test or I pass the gross receipts test, now you have the next step you have to do, which is figure out what wages are eligible. And what wages are eligible is a function of basically how big your business is. And how big your business is a function under these terms of how many employees you had in 2019. So they're determining business size based on full-time employees. And full-time employee is defined as an employee who averaged more than 30 hours a week or 130 hours a month. And then you calculate that by month, and then you divide by 12 to get your average. So I have some examples of exactly how that would work. So let's say you're going to pick the 130 hours, and what you pick is kind of a function of what kind of reports you can get out of your payroll software for hours. I took the same two data sets and computed it both ways so that you can kind of see which one might benefit you better. But this is a company and they pay bi-weekly. So when you pay bi-weekly, sometimes you're going to have 2 pay periods in a month and sometimes you're going to have 3, right? So in this example, in January, they had 3. So we compiled the information and then I did this formula, which basically says if the total number of hours for the month is over 130, then they're a 1.0. If they're not, then they're a 0. And that's basically how you count full-time employees. Anyone below the 130 doesn't even count. They're a 0. And that's what you can see down here with Ruby Castro. She's at 86 for the month, so she doesn't count towards the number. So I took the same data set and I said, well, what if I do it on the weekly method? Which you can easily do. I just computed the number of hours per week, right? They're bi-weekly. So 74.3 divided by 2 is 37.15. I did that for each week. And then I computed the average for the month. So Adam is over 30, Marco is under 30, and Ruby is under 30. So doing the math this way, the only full-time employee we have is Adam Ant. And it's the exact same data set, but when we use the 130-hour method per month, Marco Brown counted as a 1.0. So you can kind of work the math to your advantage. The 30 hours a week is probably the best way to do it if you have the data to be able to do that. But if you don't, if you can only compile hours per month, then you could use the 130. Okay, so then what do you do with that? You have to compute an average for the year. If you have only have one location, one business, one location, you just add them all up, divide by 12. If you have multiple locations and multiple businesses, there is an affiliation rule, a related party rule that says, under the employee retention credit, if you have multiple businesses that all have similar ownership, everybody has to be added together for purposes of all the limits for the employee retention credit, including this one. So you can see in this situation, this business they have 4 locations. This is actually a real company. They have 4 locations. They have 4 different LLCs. They're all separate entities, but because the ERC says you have to aggregate related parties, we had to add them all together. So that's why we went through this math to see what is the average number of full-time employees for all the businesses combined. All right, Tom.
Hey, CariAnn, somebody asked on your last slide, does it matter if the biweekly pay periods cross months?
No, so the way I did it was based on check date. So, because there has to be, I think it would be too hard to do it on a daily basis. So I just did it based on check date. And that's kind of the rationale we've been using is hours based on the check date. You could use it hours based on the pay period end date if you want. But this particular client, I took a client file, changed the names, changed some stuff so that I would have live data to use. And this is what they were able to give me out of their payroll software: names, hours, check date. And so then I had, from what they were able to give me, then I kind of came up with a methodology. So that's why I showed you the 2 different ways, so you can kind of make work whatever you have. Okay, so why does all this matter? Here's why it matters. If you do all that math and you have less than 100 full-time employees in 2019, then all of your wages during the eligible period, you can take ERC on. If that number is more than 100, you can only take the credit on wages and healthcare costs paid to or for employees who are not working. I always say, anyone who you pay to stay home and watch Netflix, that's who's in this second bullet. So I have 2 employers that actually did this. They're large employers. They both have over 300 employees. They were shut down for 6 weeks by local government order, in this case, not state. The city shut them down. And they got a copy of that order. They're due to the nature of what they do, they have a skilled workforce. They could not afford to let their 350 people go on unemployment. So they paid full wages and full benefits for 6 weeks. And these people literally stayed home and did nothing. And they were able to take the employee retention credit on those employees for that 6-week period of time when their employees were being paid, but not working. Okay, so the first bullet is called the small employers. We'll call them the small employers, 100 or less. And then the second bullet is the large employers, over 100. So the small employers, you can take it on everybody that you're paying. Large employers, it's only people you pay to stay home and not work. Okay, so what is the credit? So once you go through all of those things, what is the credit? The credit is 50% of the first 10,000 in wages and allocable healthcare costs paid during the affected period to each eligible employee. So under the partial shutdown test, let's go back to our dentist. Okay, so our dentist was only shut down for 5 weeks. So it's the 50% of the first 10,000 in wages and healthcare costs paid during those 5 weeks. Okay, let's go back to our restaurant. They're eligible for quarters 2, 3, and 4. It's the first 50%. It's 50% of the first 10,000 paid during that whole time period. So, you know, a lot of your employees, you're going to get to 10,000 after one quarter, maybe halfway into the third quarter, because the maximum credit is $5,000 per employee. Okay, so that's the credit. So you can see how this can add up really quickly, even for a small business that only has 10 employees. $50,000 is not too shabby. Okay, so there are some restrictions, and we're going to go through these sort of quickly, but sort of not, because they're important. So number one, you cannot include wages that you claimed on FFCRA. Okay, how do you know if you claimed wages on FFCRA? If you look at your 941, there's a separate line item for sick wages and another line item for family leave wages. Let me see if I can get to those. And Tom, you can tell me, 41 worksheet, original. If I pull this over, if you can see it on my screen. Do you see a 941 or do you still see my PowerPoint?
We just have the PowerPoint right now.
Okay, yeah, I can't figure that out. How to drag something on top. But if you have your 941, it's line 5A, little I and little double I. Okay, that's where the sick leave and the family leave wages under the FFCRA are reported. Okay, so those wages are out. You also can't claim it on anyone that you're going to take the work, any wages that you're going to use for the work opportunity credit. And you also can't include any wages that you use for your PPP loan forgiveness, which is not on this bullet, and I can't remember why, but that's a critical distinction. So PPP wages are out, FFCRA wages are out, and any work opportunity credit wages are out. And we'll talk at the very end about how, if you did get a PPP loan, that doesn't mean you're out of luck, right? Because the PPP covered period was like 24 weeks. And if you're eligible for a larger period, you can kind of do a sandwich kind of thing, where you take it on the ends or you negotiate the middle. Anyway, we'll talk about that, because it's still, you're not out of the program just because you had a PPP and used all those wages. You can't take it on relatives. Here's the list. This is very simple when you look at the list. Seems very simple. What is not listed here are owners or their spouses. And there's a lot of commentary online. The IRS is not clear about whether owners or their spouses are included. We've taken the position internally that we're not going to take it on owners or spouses, because it honestly doesn't make sense. Well, it's not provided for in the language. And then if you think about it logically, should you get a tax credit for keeping yourself on the payroll? I don't know that that makes sense logically. And maybe that's not why it's addressed directly. But we're not advising our clients to take it on themselves as the owner or their spouses. And then there's this list: children, lateral ownership, up and down. So it's a pretty comprehensive list. So if you have a family business and a lot of your employees are related to you, it might not be the best option. You would only be able to take it on people not related to you. All right. Oh, here it is, because I had the PPP loan on a separate restriction. So you can't use any wages, like I said, that you used on a PPP loan on the ERC. So it gets interesting trying to balance that and determine, okay, I can use this for ERC, this for PPP, this for ERC, this for PPP. But it is possible. Trust me, I've done it like 6 times. It is possible. And then, like I said before, those aggregation rules, where if you have multiple businesses, even if they're set up as separate entities, it doesn't matter. You have to really, if you own all of them or you and your friend own all of them, they have to be lumped together when you apply all of these rules. Even the gross receipts rule, the partial shutdown rule, and the employee count rule. Okay, so what does this look like? Right? Oh my gosh, please stop talking and show me an example. I'm sure it's what all of you are thinking. So here's an example. So this is a very simple example of a company, and they qualify for Q3. Okay. So what I've done is I've listed out all the wages, tips, and FFCRA compensation for all of their employees for Q3. Okay. Column 1, wages, is all wages. So that 84,000 includes the tips and includes the FFCRA. Q3 health insurance is the amount of health insurance premiums that this owner paid for these employees. Okay, so you can see over here, when we're figuring out what's eligible for ERC, in our first example, like Albert, well, he has way more than 10,000 in wages. So we need to make sure that the maximum that we include for Albert is $10,000. So there's multiple ways you could do it. You could say, okay, I'm going to take $10,000 of Albert's wages and 0 of his health insurance. That's completely okay. I did it a different way. I said, okay, well, I'm going to take his health insurance and I'm going to take his wages up to the amount I need to get to 10,000. So in this case, 9650. And then you can see I've excluded Fred, the owner, and Christy, who's Fred's daughter. We're not taking the ERC on them because Fred, as the owner, like we said, we're not taking that. And then as Fred's child, Christy's definitely on the list as being ineligible. So you have a company that, they paid $84,000 in wages plus $2,800 in health insurance. But once you apply all the rules, the eligible compensation is only $51,000. So that's important that you apply all these restrictions. And then you see what the credit is for this business. So they have 10 employees and their credit is $25,000. All right. And I tried to include some notes down here that kind of show you where these numbers come from, what the formulas are, to see kind of how you can work through that. And I'll provide this information to Esmeralda and she can distribute it after. Are there any specific questions on this slide, Tom, as we're kind of cruising through, because it's actually doing the math finally?
Nothing right now.
Okay. All right, so we've calculated the credit. We are entitled to a $25,000 credit for Q3. Now what? Okay, now what is you're going to claim the credit on an amended 941, right? This is Q3 of 2020. So that's in the past. You already filed your 941. Now we have to file an amended 941. So an amended 941 is called a 941X. Okay, and I've given the links here to where you can find those forms if you do your own payroll. If you use a payroll provider, if you use a payroll provider like an ADP, a Paychex, a Pace, one of those, you should be able to give them this worksheet and they should be able to do the 941X for you. I will caution you to make sure it's right. If they did it correctly, then at the bottom of the 941X, it should show a refund of $25,818. So even though they're experts, I'm just going to give you a word of caution, check their work. Make sure they did it correctly because it's new for everyone. And so we've had some experience where even some of the large payroll providers are not doing the 941X correctly. So just double check their work before you sign it. Okay, so there's this worksheet. Okay, so here's where I'm going to unshare if I can. And then I'm going to try to share an actual 941 worksheet and the 941X. So let me see if I can do that here.
Esmeralda, can you help her stop sharing so she
Yeah,
can?
you want me to stop sharing?
Well, it just says click new share. So I was going to try that and just try to share. Here we go. Maybe this will work. All right. Do you see a screen with a penciled in sample restaurant Q3 940?
We do see.
Okay. So in order to prepare the 941X, you have to fill out this worksheet. And the worksheet can be found at the end of the 941 instructions. So if you go online and you pull up the 941X, it's not going to include these instructions. You have to go to the instructions for the 941X to get this worksheet. And I included both of those links on that previous slide. So basically you just follow the math and you do exactly what they're saying. So here is the original. Can you see the original 941, Tom?
Yeah, we could see that.
Okay, so this is the original 941 that this business filed, or this fake business that I made up filed hypothetically for Q3. And you can see here's their wages, here's the sick leave wages that we talked about, here's the tips, because tips are not included for ERC, because tips are, if you think about it, technically not paid by you, they're paid by the employee, the customer. So those are excluded from ERC. So here's our original 941. So you just take all these numbers from the 941, like it says, enter the amount, so security wages from 941, line 5A, column 1. So you go here, line 5A, column 1, 77,963. So this is not a hard form. It's intimidating, don't get me wrong. I'll show you how long it is. It's a long page, and so it's intimidating, right? You pull that up and it's like, oh my gosh, I can't do this. But you can't. You just work through it. It tells you exactly what to do, tells you exactly what the math is, and gets you down to the numbers you need to know. So just go through it step by step. I promise you can do it. If you want, here's how honest I'm going to be about this. So I don't know if you noticed from my intro, I'm not a tax person. I'm an auditor. I work with 401k plans. I'm not a tax person. And I'm not a payroll person. So when our clients needed this service, I'm like, okay, well, I'm going to have to teach myself how to do a 941 and a 941X because I've never done that before, right? I'm a CPA for 25 years, but I don't do payroll. That's not my service area. So I Googled it online. How do you prepare a 941X for the employee retention credit? And up came like 6 videos of sweet little people that will teach you how to do it for free and show you exactly how it works. And that's how I taught myself, because if you pull up the instructions, they're like 25 pages. I mean, I don't want to read those, and I'm sure you don't want to read those either. So I took the shortcut, just like you're welcome to do. And I watched a video about how to do it. And she went through this worksheet. You know, she showed, okay, you pull this number here, you just follow the rules. And it was not that bad. So you're welcome to Google how to do that and watch those videos, because they're really nicely laid out. So anyway, the whole purpose of this is you get down to these numbers that are called, sorry, right here, the refundable portion and non-refundable portion. I will tell you those words mean nothing in terms of what is actually refundable is the math of the 941. So don't get hung up on this and say, oh my gosh, my refundable portion of qualified sick leave wages is 0. Doesn't mean anything. Okay, it's a fully refundable credit, just like the employee retention credit is. And you can see that down here, because once you get the sick and family leave refundable and non-refundable calculated, then you have to do the refundable and non-refundable portion of the employee retention credit, which is this section. Once again, just follow the lines. It's really not hard. Enter your qualified wages. If you remember from our worksheet, those are $49,000. Enter your health plan expenses, $2,100. Add the lines up. That's 3E right here. What's the retention credit? Multiply the 51 by 50%. There's our 25,818 we were talking about. And then you just enter the numbers from the form, enter the numbers from previously on the worksheet, and it gets you down to this non-refundable and refundable portion. Again, you just report that. Let me see if I can open up the 941X. All right, can you see the 941X, Tom?
Yes.
Yep, it's on.
Okay, so this is what the 941X is actually going to look like. So this is just a bunch of check boxes. You get down here on a 941X, all you report is the thing that changed. Okay, so if you're filing amended 941 for Q3, all you're changing is the employee retention credit. So that's all you're going to report as changing. So you can see most of the stuff is blank. And then until you get down here that says non-refundable portion of employee retention credit. Well, from my worksheet, that's 3,087. So I enter that number. Continue on down here in the totals. Keep going until it says enter the refundable portion. Well, that comes from the bottom of the worksheet, 22,730. Okay, that is a negative effect on your tax. At the end, the total, negative 25,818.33. Again, that's our number from our calculation. So we know we've done it correctly. This number is less than 0. You know, tell us what you want to do. If you checked, so our number is less than 0, and we checked that we wanted to take a claim. So this is going to be refunded. And I can show you that. So back up here on the first page, you're going to certify that you filed your W-2s like you're supposed to. You're going to check the box that you want this to be a claim. Okay, so check this if you've over-reported amounts and you want to use this process to ask for a refund. And that's what you want to do. So when it references claim down here, that's what that's talking about. Okay, so that's basically it. And then you have to tell them what are your gross wages and what's your healthcare expenses. And you just put those numbers down here. Again, the columns are what's the right amount, what did you report previously equals the correct amount. And that's basically it. You have to put a explanation on line 37 of why you're filing a 941X. And basically the explanation is I'm filing this to claim the employee retention credit. If you got a PPP loan, you could talk about how you didn't used to be eligible for ERC because you got a PPP loan and now you are. But it's very simple. They give you a long spot to write a narrative. You don't need to write a narrative. It can be very simple, 2 sentences. And then you sign it. So that's a 941X. If you notice, I'll just kind of scroll out here so you can see. It's not a lot of information, right? The hardest part was figuring out, am I eligible? What's eligible? Calculating the number. Filling out the form itself is not challenging. Okay. So let me pop back to, if I can.
Here, I'll do it for you again.
Yeah, can you unshare for me? Okay, and then
Yeah.
I'll reshare my PowerPoint. Okay, we back to the PowerPoint?
Yes.
Okay.
Oh,
excellent.
sorry about that, actually. Can you pull it back up?
I'll do it one more time. Yeah. Okay.
Thank you. It's on there now.
Good. All right. So that's the logistics of how you actually claim it. Okay. So here's the bad news. So the bad news in all of this is that a 941X has to be filed in paper. There is no electronic system currently set up for a 941X. So you have to print it on paper, you have to sign it, and you have to put it in the mail. The IRS is still not caught up on its mail from when the pandemic hit. So when the pandemic hit, the IRS closed all its offices and basically quit processing paper. And if you think about it, a lot of people file their plain old tax returns in paper, right? I do. I don't like the electronic thing. Paper makes me feel warm and cozy. So I still file my tax return in paper. They got so far behind in processing paper income tax returns, they are not caught up. Okay. So unfortunately, that means they're way behind in processing anything that goes to the IRS in paper format. Right now, we're seeing at least a 6-month or more delay in the timing between when you file your 941X and you actually get the refund. I won't be surprised if it gets longer because the IRS is so far behind. So it's really hard because it's exciting to tell a client you qualify for this, here's how much your credit's going to be, and then I have to be the bad guy and say, oh, but by the way, the IRS is so far behind in processing paper, I have no idea when you're going to get your money. But that's the reality of where we're at right now.
And CariAnn, I was just going to add to that, in addition to basics you've talked about, they've also been dealing with 4506Ts for shutter venue grants, restaurant revitalization, all the other disaster relief that's just, piled on in terms of the delays.
Right. So yeah, you kind of have to ask yourself, okay, well, if I can't get my money now, should I do it? I mean, that's your decision, but it's still a credit. If you're eligible, it's a credit you're entitled to. So you just have to know going in, there's going to be a really long wait at this point to get the money back. And I talk really slowly to make that clear because I don't want anyone thinking, oh, I'm going to file this next week and I'll have my money by Labor Day. And that's not going to happen. I promise. You'll be really lucky if you get it by Christmas, but I wouldn't be shocked if you didn't get it until 2022. Unfortunately, unless something changes significantly. And if you Google it, you can find articles about how far behind the IRS is in processing. We have some clients whose 2019 tax returns that were filed in paper for a variety of reasons haven't been processed, or amended tax returns from like 2018 that were filed in 2020 haven't been processed. So it's kind of a mess that the IRS is in right now. Anyway, we'll move on from the bad news. Okay. So there are some articles on our website about the employee retention credit that kind of talk about everything I've talked about here. The IRS also has 94 FAQs on the ERC. And if you go to this website, they're broken down into categories. But like if there's 94, they'll probably answer almost any possible question you could come up with, except the important ones, like our owners included. But they do have a really good FAQ. Okay, so remember I said we're going to talk about 2020 until you see another blue slide. Okay, well, here we are. Here's the blue slide. So everything I've talked about so far is just for employee retention credits for 2021 or 2020, sorry. Now we're going to talk about 2021. Okay, the rules are very similar, but they're slightly different. And I've tried to point out on the slides what is different about 2021. So that if you get these and you go through the handouts and you're trying to figure out, well, what the heck is she talking about? But I will point out what's different and what's the same.
Hey, CariAnn,
Okay.
quick question.
Yes, you got
It
it.
just came in. Are primary care medical practices considered essential and therefore not qualified?
Okay. So you would have to look at the facts and circumstances to see if they meet the full or partial shutdown test, but they're definitely eligible for the gross receipts test. Okay. What a primary medical practice is going to have to be careful of is if you got provider relief funds, PRF, they believe is what they're calling them. Those, I believe, are included in your gross receipts. So even though if your practice wasn't generating a lot of revenues, I'm pretty sure the PRF money gets included in your gross receipts, so it might affect your eligibility for that gross receipts calculation. Now, so primary care is one thing. If you're a specialty provider and you, like, let's say you're a neurological practice and you do brain surgery, surgeries were shut down except for what emergency? I mean, so is brain surgery emergency or elective? I mean, that's a big discussion we can talk about, but you kind of have to look at the facts and circumstances of your actual business and what you do and how those government orders directly affected you. What did you literally have to stop? Because if you didn't, the governor, had the authority to do something to you or whatever. Okay. Any other questions? I'm going to kind of cruise through these pre-questions that I got beforehand.
There was one. Someone asked, given the delays in refunds, and they say shouldn't, and I guess I would say can, a business apply for credits against future payrolls instead of waiting for a refund?
So, okay, so the answer is yes, you can have it applied. The hazard is you won't know when they got your return and applied the credit. So when I was going through the 941s yesterday, I was like, okay, if you claim the employee retention credit on an ongoing basis, so let's say you determine that you're eligible for Q3 of 2021, and you actually claim it on the original 941, those refunds are being processed timely. You'll get those within 60 to 90 days. What worries me about applying it is that I think you're still subject to the same time lag, meaning you won't know when they've actually applied it. So you've got to keep paying your payroll taxes the whole way. Otherwise, if you quit paying your payroll taxes in anticipation of this credit that you're going to apply, the odds are you're going to start getting notices from the IRS about not paying your payroll taxes, and they're going to try to assess interest and penalties against you. So not to say you couldn't get those abated potentially, but it would be a really big hassle because you'd have to deal with all of those notices, which I guarantee you will come. They for some reason, their processing of notices has not slowed down one bit. It's just their processing of paper coming in, not the processing of paper going out. So that's something to be aware of. Okay, let me just cruise through these right quick. My company, blah, blah, blah. Oh, here's a question. My company is a single member LLC. I'm the only employee. Can I qualify for the tax credit for myself as an employee? The way we read it, the answer would be no. Just doesn't seem logical to get a tax credit for paying yourself. So our interpretation is no, but there is ambiguity out there in that rule. And the IRS hasn't just come out and said one way or the other. Okay, how do you get updates on your ERC from the IRS when you've already filed your application? There's been no response. I have no idea. I mean, I have a client that filed hers in January, and I keep asking her if she's heard anything. The answer is no. She's unable to find out if they've even received it. I don't know. Do you have any thoughts, Tom? It's really sad.
No, it's a tough one, and we run into this with some of the other programs that are run out of the Office of Disaster Assistance, that it's, you know, a little bit difficult to find information. So I think all I preach to people is as much patience as you can muster.
Right. It's going to be challenging, that's for sure.
And we did have one more question. You mentioned partially suspension. That means you have restrictions on capacity or similar. Is that correct? Partially suspended, sorry.
Yes, so full or partially suspended means government order said you could not operate as normal. And there's a lot of definitions of that. I mean, there's a lot of examples in the IRS notice. The restaurant one is the easiest to understand. You can't do dine-in, or a dentist, you can't do routine care, or a surgeon, you cannot do elective surgery. Those are very simple. I'm trying to think of other examples. Most of the ones I've done for our clients are along those lines.
Well, any business that might have had more than, let's say, 50 people, where there are crowd restrictions, if that's the core of the business.
Oh, right. So you're talking like an
Entertainment.
event hosting venue.
Sure.
And the limit was 50, and normally you host 200 count weddings, right? That would probably be a qualifying event. You're right. Bars, that were shut down, gyms that were restricted to capacity. Just thinking back through all the executive orders and the different ways, different types of businesses that were shut down. Cosmetology, that was easy. They were shut down for a while. Okay, so for 2021, this bullet point 1 is exactly the same. Bullet point 2 is exactly the same. And I want to highlight it's exactly the same, meaning 2019 is still the base period for comparison. Okay, so for all these programs, 2019 is the last normal year. So even though we're looking at a credit for 2021, if you're looking at gross receipts, you have to compare yourself to 2019 because that's the last time you were normal. Okay, so it's not just a comparison to the prior year, it's a comparison to 2019. Okay. And then the guidance in either December or March, I believe, the ARPA added this concept of the recovery startup business, which we talked about, which is a business that started after February of 2020 that could potentially be eligible. This is the same slide. The rules on full and partial shutdown are the same. So in our example of the restaurant, once the restriction on indoor dining was lifted, a restaurant no longer qualifies unless they meet the gross receipts test. Okay, so while it was easy to get all the hospitality people eligible for 2020, 2021, that ends as soon as the executive order is restricted. And then some of the restaurants are starting to look to the gross receipts test to see if they might qualify on that test. And that test changed slightly. We'll talk about that. So the gross receipts test, the only thing here's 2 things that changed. And I'm going to skip over to the example on the gross receipts test. So it's now an 80% test. So it says if your gross receipts are less than 80% of your 2019 gross receipts for the quarter, you're eligible. And you stay eligible until you get basically, well, you don't stay eligible. I said that wrong. For 2021, it's a single quarter calculation, except that they have a look back rule. Of course, there has to be an exception. So you look at each quarter individually, or you can be eligible if the quarter before is eligible. So if you think about that, if you're eligible on the gross receipts test for 1 quarter, you're going to be eligible for 2 by default. So you know, in the example here, example 1, both quarters are below 80%. That's easy. Okay. In my example 2, in the first quarter, I'm actually not below 80%. But if I look back to the previous quarter, which would be comparing Q4 of 2020 to Q4 of 2019, that was below 80%. So now I'm eligible for Q1. And then I'm going to look to Q2 and it's eligible on its own. But an example would be if back over here in example 1, let's say my Q2 revenues were the same in 2021 and 2019, I'd still be eligible for Q2 because of the look back rule. Because I could look back and say, well, I was eligible for quarter 1, so I'm also now eligible for quarter 2. So if you get 1, you get 2 on the 2021 gross receipts test. Okay, and like I said, it's 80%. Remember, 2020 is 50%. So it might be a lot easier for businesses to qualify on the gross receipts test for 2021 than it was for 2020. Okay, here's a little more information on the recovery startup businesses. And then there's this whole concept of severely financially distressed. I'm not going to go into details on that because it's a lot of numbers and we're already throwing around a lot of numbers. So if you think you're in those situations, you should go back to the slides after this and kind of look at that. But we're going to kind of focus on the high level gross receipts and the partial shutdown. Okay. So you decide, am I eligible on partial shutdown or am I eligible on gross receipts? Then you, just like before, you have to look at your number of employees. Again, your employees in 2019. So it's the exact same calculations, okay? So these are the exact same slides as I had in 2020. Exact same computations, same people, same data set. Because again, 2019 is still our comparison period for this test. Okay, so what changed? Here's what changed. Now the cutoff is 500. So if before, you know, all was well and good until you got to the full-time employee test and you have 110 employees, you know, really restricts what you're eligible for in 2020. But in 2021, now you're eligible for the full credit on wages paid to everybody. Okay. Really large employers are still eligible for the 2021, but only on wages paid to employees who are not working. Again, back to our at home watching Netflix, but that's really rare, I think, these days. I think very few employers are paying people to stay home like they did in 2020. So a lot more employers are going to be eligible because of the 500 and the 80% as opposed to 50% on the gross receipts. So what's the credit? And now the credit is more money. It's 70% of the first $10,000 of wages per quarter. Okay, so that means you could be up to $28,000 per employee if you qualify for all 4 quarters in 2021. So we're talking a lot. I mean, it's a lot of money if you qualify. I mean, it's unfortunate that you qualify, right? Because it means your business is struggling and you're not doing that great. But it in turn means you're going to qualify for a lot of these credits. Okay, the restrictions we talked about for the first one are exactly the same. The FFCRA, the work opportunity wages, those are out. The relatives, they're out. The wages you use for PPP2, some of you got a PPP2 loan. That same restriction is in there. Anything you use for PPP2 forgiveness, you cannot use for ERC in 2021. And then the aggregation rules again. So let's look at the exact same data set, except let's pretend it's for 2021. So the math is literally all the same. The only thing that changes is this last column where we compute the credit. It's now 70% instead of 50%. So instead of a $25,000 credit for this quarter, we're looking at a $36,000 credit. So the math is the same, with the exception of the percentage. The process to claim it is the same. So if it's July 27th, so the odds are you've probably already filed your Q2 941 for 2021. So if you're going to go back and take this for Q1 or Q2, you would follow the exact same procedures that we talked about for filing a 941X for 2020. Okay, exactly the same. If you see yourself eligible going forward, Q3 and Q4, you can claim it on your originally filed 941. Okay, and like I said, that's better because those a lot of times are filed electronically, and anything that gets filed electronically is processed automatically. And so those refunds are coming timely as opposed to having to wait for them. So I'm going to do the same. I'm going to just show you what that would look like. I'm going to stop sharing. I'm going to share, go open this up here. Bear with me. Sorry about this. Original 941 with ERC. Here we go. All right. Okay, so now do you see a 941 for 2021?
Yes.
Okay, so this is, let's say this is for, we're going to claim this for Q3. So this 941 is going to be due in October, 3 months from now. Here's what it would look like. You would report your wages just like we did before. The reporting of qualified sick leave and family leave wages is different for 2021. And that's kind of indicated out here with this little bullet point. Oh, sorry, that highlighted the whole thing. But you can, and it gets back to the worksheet again, unfortunately. So there is a worksheet. Q3, here we go. So here's what the worksheet looks like for 2021. Now, when you get to the worksheets for 2021, there's 5 pages of worksheets at the end of the instructions instead of 2. So you have to read the headings at the top and make sure you're getting the right worksheet. In this case, I'm using worksheet 3. It's credit for qualified sick and family leave wages taken after March 31st, 2021. Okay, and then the next page is employee retention credit for the 3rd and 4th quarters of 2021 only. So there are specific worksheets depending on which quarter you're claiming, to make sure you pick the right one. And again, you do the exact same thing. You just follow the instructions and work your way down line by line until you get down to what, like I said, all the purpose of this is just to compute the refundable and non-refundable of both your sick and family leave, and then also of your employee retention credit, non-refundable and refundable, so that you can then put those on this line, these lines over here on the 941. Here we go. Here's the non-refundable portion. Sorry, I won't highlight the row. Line 11, excuse me, 11D, non-refundable portion of your sick and family leave. And then in this case, our entire employee retention credit on the worksheet came out as refundable. So we're going to report that down here. But if you've continued to deposit your payroll taxes as normal and not reduce them, then the refund is still the $36,000. Now, can you reduce your payroll tax deposits as you go? Yes, you can. You just need to be really sure about what your employee retention credit is going to be if you're going to do that. So you could choose to reduce as you go, and then that would just change your deposits for the quarter on line 13A, which would then reduce your refund. And then right down here, your overpayment, like the participant mentioned, you have a choice to apply it to the next return or send a refund. And it's up to you which one you do. If you're doing this on an originally filed return that you're going to file electronically, you could probably click apply to the next return and use that to reduce your deposits for the Q4. Or you can select send a refund, and you should get it within 30 to 60 days is what one client told me, I think is how long they took to get their refund. So anyway, you can file it on an original 941 for Q3 and Q4 if you want. Same kind of thing, you report the wages, the health plan, and the sick leave wages down here at the bottom, and then you sign. So an original 941 would look like that. All right, I'm going to stop share. I'm going to go back to my other presentation here, maybe. All right. Okay, this is just a slide that talks about how the non-refundable portion, the refundable portion don't mean anything. It just determines what lines they go on the 941. the ERC is still a fully refundable credit. So just keep that in mind when you see those words. Okay, so it's the end of my PowerPoint presentation, but I want to kind of talk about high level PPP and ERC, because this affects a lot of people. Let's talk about 2020. It's hindsight, everyone can kind of think it through. So a lot of clients got a PPP loan, let's say May 1st. Okay, so they got their PPP loan on May 1st and they had 24 weeks to use it, right? So they would have had until approximately October 15th to use their PPP loan. The odds are you've already filed for forgiveness. Side note, if you haven't filed for forgiveness, you really need to, after this webinar is over, clear your calendar and you need to file for forgiveness, because if you don't, you're going to have to start making payments on that loan. There's a sunset provision on the payment deferral. It's 10 months after the end of your covered period. So that sunset period is coming up for all these loans. It starts around the end of July, which is now, and continues into August. So if you have not filed for forgiveness, remember everything I've told you, but put that aside and go file for forgiveness on your PPP, because it's way more important right now. You need to get that taken care of. Okay, but assuming you've already filed for forgiveness, you're not really stuck, because if you included more wages on your loan forgiveness application than you needed, you can use those excess wages for ERC if they fall into a time period for which you're ERC eligible. Okay, so let's say for simple purposes, your payroll is $10,000 a month. Okay. And so the PPP forgiveness period was 24 weeks, that's 6 months. So let's say you put $60,000 of payroll on your loan forgiveness application, but you didn't need all that payroll. Let's say your loan was only $30,000. So you've got an excess $30,000 sitting on that PPP loan forgiveness application. If you were eligible for the ERC for Q2, Q3, and Q4, you can break it down like this. You can take all of your wages in April, right? Because you didn't get your PPP loan until May 1st. So all of your April wages would be eligible. During the covered period, which is in our example, May 1st through October 15th, you can use those excess $30,000 for the ERC. And then you've got the last period, and this is why I call it a sandwich, right? An Oreo, whatever you want to call it, where you have two ends in the middle. Okay, the covered period is your middle, and you've got two ends. The two ends are eligible by default, right? Because there's no PPP interference. So as long as you're looking at Q2, 3, and Q4 for eligibility, you can take those the bread periods, if you want to call it that. So in our example, 10/15 through 12/31, those wages are ERC eligible. The April period over here, that's eligible. And then the stuff in the middle of the sandwich, whatever you had that's excess PPP wages, you can use that. So it takes a lot of math, and I have a worksheet for that, but I promise you do not want to see it because it is complicated. Because most of the ones I've done it for were restaurants. And so not only are you looking at wages, but a lot of them paid FFCRA, and they also paid tips. And so the math is intense to figure out all of that, because tips are eligible for PPP, but tips are not eligible for ERC. So it is possible. And someone asked for the worksheet, and I'm going to have to say, sorry, that's proprietary. We've poured a lot of heart and soul into that worksheet. So it's not something that we're sharing. But it's a calculation that you can do. You just have to break it down into all the pieces on a per employee basis and figure out what you can use. So it's doable. It just takes a lot of time to go through the math. And the same thing would apply for 2021. If you have a PPP2 loan in play, do the same kind of thing. Look at the time period before your PPP loan, look at your covered period. Now, you probably haven't filed for forgiveness on your PPP2 loan yet. So you have a little more flexibility on that. You could specifically only say, okay, I'm only going to put these wages on the PPP application. I'm not even going to put the rest on there because I'm going to save that for ERC. Definitely do that. But it's just a matter of looking at what period you're eligible, figuring out what you've got going on, and then doing the math step by step by step in order to maximize both of those programs. And I'm not going to lie, it takes a long time. I mean, the first one I did probably took me over 20 hours, if not more, just to figure it all out and figure out the math and figure out the formulas, because at the end of the day, you do all that math, then you have to break it down by quarter because you have to file the credit on a 941, which is a calendar quarter, which probably does not align in any way, shape, or form with your PPP covered period. So it's a multi-step process to figure out what your ERC credit is going to be. So is that convoluted enough, Tom?
Absolutely.
Okay.
But even if you think about it, CariAnn, if it's say $50,000, if you spend 20 hours, it's still what, $250 an hour or something? It's a lot of money.
Right.
So.
Right. Okay,
did
so
have a question.
Esmeralda, I see that question. Is that what you're
Yeah.
going to?
You want to
Okay, so the question
read it out
is,
loud?
yeah, can we amend our PPP forgiveness application? The answer is no. There is no provision to amend an application. Once you send that thing in and it's with your lender, it's set in stone. So you have to evaluate what's on there and figure out if you have anything that's available to free up. But you're right, if you had known, right, in hindsight, and I get it, trust me, we were advising all of our clients that we were consulting with, go payroll only on your PPP forgiveness application. You know, there's no downside, right? It's easier. There's less documentation to support, go payroll only, okay? Then Congress comes out in December and changes the rules. And now we're all mad because we use payroll only on our forgiveness application. So you don't get a do-over, but you are able to, like I said, if you have any excess, you can pull that payroll out if you have excess and use it for ERC if you're eligible. So, all right. What else?
Any other questions out there?
Seems like we don't have any questions, and there's nothing in the chat.
Okay. Well, we'll go ahead and move on. CariAnn, thank you so much. It's been incredible information. It both confused me and got me enthusiastic about it at the same time.
Right.
It's clear that getting some professional help would be a wise idea for folks to get a little help in this area. But it's clear there is an opportunity for everybody. And it's clear it's something that needs to be done with great care. So I think you did an amazing job, and you said you need to be awesome, and you absolutely were. So thank you.
Thank you. Appreciate that.
And just a few quick tips. If we can help you at the SBDC, you can go to this website and just submit a request for counseling. If you're already a client, thank you very much. And this is, statewide. Just you can also get this as the Maricopa site, but you can get go to the AZ SBDC network and get it statewide as well. Let's see. The way we work, we got an initial counseling session where I work with you to identify business goals and areas of assistance and needs. And then you meet with your counselor for regular follow-on sessions and guidance and different areas of support. And then work with you to track and report metrics. So we have some other upcoming webinars. On August 5th, Reviews Matter, How to Manage and Optimize Your Reputation. On August 17th, we have our Grow with Google webinar, Get Your Local Business on Google Search. On August 24th, some exit strategies, planning now for future success. And on September 8th, Manage Your Customers Effectively and Efficiently. And when you get this, you'll see there's a link there to sign up for events, or you can just go to our website and sign up that way. And also on our website, you'll find our trading event calendar, and you'll find biographies on all the counselors and pictures of ourselves that we probably all don't like. So you can find that as well. And before I turn over, I saw we have one more thing come up in chat. Esmeralda, was there anything there that we need to address?
No, I just wanted to mention that the recording will be sent out via email today. and I will provide any documents that CariAnn will share with you all. But other than that, thank you all for joining us today, and thank you so much, CariAnn and Tom, for today's presentation.
All right. Thank you, everybody.
Have a nice day,
wonderful
everyone.
Thank you.